In this video, we will explore interpreting open interest and put-call ratio for trading strategies. To begin, we need to understand a very important term called open interest. You can think of open interest as the total number of positions that market participants have opened but not yet closed. For example, if a May index futures contract shows an open interest of 2,56,000 contracts, it means that traders have bought or sold 2,56,000 contracts and are still holding on to them. These positions are still live in the market and have not been settled or squared off yet. Now, there is a new way to measure this, known as the new formulation of open interest. Instead of just looking at the total number of contracts, we now look at things at a portfolio level. We calculate what is called a net delta adjusted open position. This includes both futures and options for a particular asset. The goal of this new method is to make sure that the futures market more accurately reflects what is happening in the actual underlying market. To understand this new formulation, we must look at a concept called delta. Delta is a measure that shows us how sensitive the price of a derivative is compared to the movement of its underlying asset. For example, if the price of a stock moves, the delta tells us how much we can expect the price of an option or a future based on that stock to change. Let us look at how different positions have different delta values. For a long futures position, the delta is +1, which means you gain 1 rupee for every 1 rupee rise in the underlying asset. On the other hand, a short futures position has a delta of -1, meaning you lose 1 rupee for every 1 rupee rise in the asset. Options are a bit different. A long call has a delta between 0 and +1, giving you a partial gain when the asset rises. A short call has a delta between 0 and -1, leading to a partial loss when the asset rises. For puts, a long put has a delta between 0 and -1 for a partial gain when the asset falls, while a short put has a delta between 0 and +1, leading to a partial loss when the asset falls. We can see how this works in a real calculation for what we call future equivalent open interest, or FUT EQOI. Imagine we have different clients with various positions. In the old system, which we call Notional OI, we just added up the contracts. For example, if client 2 had 500 long call contracts, we counted it as 500. But in the new system, we multiply those 500 contracts by the delta of 0.5 to get a future equivalent OI of 250. By doing this for all traders, we get a more accurate picture of the market's actual risk. When we compare these two methods on a market-wide scale, the difference is clear. In our example, the old notional O I might show 2,800 contracts, while the new future equivalent O I shows only 900. This new approach, introduced by the Securities and Exchange Board of India, better aligns the futures and options market with the cash market. It strengthens risk management and makes trading more convenient and transparent for everyone involved. Next, let's look at two other key metrics, starting with total traded quantity or volume. Volume is simply the total number of contracts that changed hands during the day. For instance, if 2 lakh contracts were traded today, that is your daily volume. Then we have the put-call ratio. This is a simple ratio where we compare the trading volume of put options to call options. We can calculate this using either the daily trading volumes or the total open interest. By combining the futures price and the open interest, traders can build powerful trading strategies. We look at how these two variables interact to decide whether it is a good time to buy or sell. There are 4 main scenarios we look for to understand what the market is telling us. In the first scenario, if the futures price is rising and the open interest is also increasing, we call this a bullish trend. This suggests that new money is coming in and traders usually prefer to go long on futures. In the second scenario, If the price is rising but the open interest is declining, it indicates short covering. This means traders who had bet against the market are now closing their positions, which causes a temporary rise in price. Moving to the third scenario, if the price is declining while the open interest is increasing, it shows a bearish trend. This means there is a buildup of new short positions and traders often choose to go short. Finally, in the fourth scenario, if both the price and the open interest are declining, it is known as long unwinding. This happens when traders who held long positions are selling them off to exit the market, which keeps the price moving downward. To summarize these movements, think of it this way. When price and open interest both go up, the sentiment is positive and bullish. If the price goes up but open interest goes down, money is exiting and it is just short covering. When the price goes down but open interest goes up, it is a negative market sentiment or a short build-up. And if both are going down, it simply means the buyers are quitting their positions, leading to a continued price decline. Now, let us look closer at how to calculate the put-call ratio or PCR. Suppose the open interest for put options is 8,000 and the open interest for call options is 12,000. To find the PCR, we divide 8,000 by 12,000. This gives us a ratio of 0.67. This number helps us understand the balance between the buyers and sellers in the options market. We generally use the put-call ratio as a contrarian indicator. If the PCR is less than 1, like our previous example of 0.67, it means there is more open interest in calls than puts. This suggests that sellers do not expect the market to rise, signaling a bearish trend. However, if the PCR is greater than 1, it means there are more puts than calls. This is actually a bullish signal because it shows that option sellers do not expect the market to fall. By reading these signals, you can better plan your own trading moves